There we go.
Hey, everybody, and welcome to the 33rd episode of the Insiders on Real Estate and Marketing. I'm your host, Sandy Hibbard, and I'm joined by my co-host, Mr. Marc Miller, who is president at Secured Title of Texas, who sponsors our show. So a great big welcome to everybody. We have a great show today, and very timely. We're always a little bit ahead of the times as being the insiders. We want to let you know a little bit of what we feel like is happening on the inside of the market. And we have no better person to do that with today than Mr. Matt Aycock. And he's a managing partner over at Pratt Aycock. And his specialty is helping his clients stay out of financial trouble. So we're going to talk today about the market, the foreclosures that might be coming, the taxes that might be wild and crazy that you're going to have to pay, and what Marc and Matt think about that from a professional standpoint, being in the trenches as they are in this kind of business. So welcome, everybody, and welcome you, Mr. Marc.
Thank you.
How are you?
I'm doing great.
Good.
I'm doing great.
Good.
Fortunately had a very good month and closed $140 million in commercial transactions, which is a blessing.
And you've been saying for months that it is commercial that is running this show right now.
Oh, absolutely. Now, and that's probably going to shift a little.
You think?
If they continue to bump on the rate side,
Yeah.
which I think they will.
Yeah.
But until then, we've had a really good month, and I feel blessed that we have, because a lot of companies out there are in either residential space only or refinance space only, and we had the benefit of having multiple channels of revenue. So we're doing really well. I feel like we're really secure.
Secured Title of Texas, people.
There you go.
And by the way, a word about them. They are a title company that is grassroots right here in Dallas. They have a team of professionals that are veterans. They know how to get things done when other companies can't get it done. This guy and his team of professionals will. So reach out to them. Go visit their website, securedtitletx.com, and take a look at their lineup of leadership, the people that you would be working with, probably some that you know, and the kind of services that they offer. Secured Title of Texas. So, Marc, we have a good show today. I'm anxious to jump into this because we could be talking about this for, I know, a lot longer than we're going to have time to.
Right.
Why don't you introduce Matt? Tell us a little bit about him.
Sure. Well, Matt, as you pointed out, is a partner at Pratt Aycock. Matt has been around and in the title business for over 20 years. He has an affiliated relationship with us, which I'm very happy about. He started grassroots as a title examiner. And,
Really?
that'll get you out. That'll make you want to get public quickly.
Many years ago. Yeah. That's why I wear glasses.
Anyhow, he practices a little bit of everything. And you said he helps people stay out of trouble. Sometimes he's trying to help people get out of trouble.
That's true.
Oh, I'm sure.
And deals with all aspects of real estate. He also works in investor strategies, wealth protection, estate planning, entity formation. So he has kind of the full gamut.
Yeah.
He's who I'm going to think to turn to if I get a call that somebody says, I need help.
Right.
Or we know it's going to need to be outside counsel.
Okay. I'm anxious to see what that entails.
Yeah. So anyhow, and Matt and I have known each other a long time. I respect him, and he is very knowledgeable. And he's always been sort of the front side of when we start to see where I think we are now, which is the reality is the default market is beginning to surface, and we don't know what that's going to look like, but we can speculate to that side. And so I want
Forbearance bought us time,
bought
didn't
some time, but that's kind of been unraveled, and now the reality of what we're at now, which is a number of different scenarios. But I also want to visit a little bit for our Realtor following about some of the issues that Matt is seeing, that he's being brought in to represent parties in transactions, and what some of those things are that are happening that are probably preventable to some degree, and sometimes not. Sometimes you can't get parties to agree, and then the contract busts, and now you got to deal with the outcome from that. So anyhow, I welcome Matt here with us today, and we'll talk a little bit about everything, but let's just kind of start. And Matt, kind of give me your assessment, because you're in contacts with the lender side, and let's talk a little bit about what you're seeing in your vision, what you think the default market might begin to look like over the next 6 months.
I can tell you what it should look like. if you just look at the time from March of 2020 to date, you're looking at almost 3 years essentially of almost no default activity. They were taking back, homes if there was a death or something, but they were not foreclosing on people that were living in the home for almost 3 years. If you assume there was no negative impact at all on people's economic well-being during that period of time, you're still going to have a certain percentage of default every year. It just naturally happens. You've got deaths, divorces, job losses, those normal things that happen. And one of the things that helps keep property values in a more reasonable level is the existence of this foreclosure market to help drive people to have to sell their home because they can no longer afford it. And it makes things a little bit more affordable. And I think a lot of what we saw in terms of appreciation of assets was tied to the fact that we did not have a default market at all. And I think that played a really big role in what was causing those values to go up. We're going to see catch up. It's going to feel like the '08 crash. It's going to feel like that. The numbers may even be pretty close to the same initially, but it's just catch up. If you just look at catch up work, that's all it is. It's nothing new. Because we were just talking before we went on the air.
Are you talking about it balancing out when you say catch up
Correct.
the price?
Yeah. Well, it should.
Index is going to catch up to the reality, or what exactly you mean by that?
These are scenarios where it's people that should have been foreclosed on in 2020, 2021, or this year, and instead they got an extra 6 months, 2 years, whatever, for free.
Right.
But they're not going to be. They're not current,
Right.
and so they can't keep the home, and so they would have been foreclosed on in the past, and now it's just going to happen mostly next year. Things have already started. Foreclosure filings are up significantly, and they are going to continue to push forward next year until that catch up is made.
So forbearance wasn't forgiveness.
It is not.
Okay.
It's not. There was some components where they would tack the interest on the back end of the loan, extend your loan out. There's also through FHA and VA type programs, they have what they call a partial claim, which is where essentially the HUD or VA kind of steps in and gives a little bit of money to catch things up with the actual lender, but then that same dollar amount tags on as a second lien. So those are the things that have been done, but nothing was done to fix the problem. It's just postponing the inevitable,
Gotcha.
typically.
Right. Wow.
Yeah. So,
When you say 2008, it's like everybody shudders. So
Yeah.
how is this different? Can you give us a comparison of how this pans out differently from 2008? We know that there's some issues coming up, but is it going to be that bad?
Well, the way that we did really well when everything happened in '08 we stopped being able to take advantage of the market until about 2012. Things starting to normalize again. We represented a lot of hedge funds and different people, and we would go in and we would buy performing, sometimes non-performing debt from banks that were going to fail. So if you fall under a certain Tier 1 capital ratio, which is just how much money does a bank have to cover outstanding liabilities and whatnot. If you fall under that threshold, you get put into receivership. Well, nobody wants to go into receivership. And so what they would do is they would drop their assets, which are, they would drop their loans. They would say, hey, this is a face value of $1 million. We'll sell it to you for $800 because we need the cash and, to hit our books. And so that was happening a lot. That's the big difference. I don't see any of that right now. Of course, I'm getting called by all my old friends. They're like, hey, are you seeing anything, Matt? Is there anything to buy? There's not.
Are
Not
you
that
seeing
I'm
anything like that?
no, I think the banks are in pretty strong.
Banks have tons of money, tons of coverage.
Plus, they got
Yeah.
rates climbing, which you see on one side from the origination,
Yes.
but on the other side, that's good for them.
Yeah, banks are incredibly healthy unless something else changes. There's nothing about this that looks anything like '08. I don't see any of the major financial institutions struggling. And then not to mention most mortgages, now they're backed by not just FHA, VA, or Fannie Mae or Freddie Mac. That's probably 90% of all mortgages right there. So either government-backed or quasi-government-backed, mortgages are, they can shift that risk onto the federal government, which then would shift it back to us, of course, but it spreads the risk out. So a bank collapse it would not make sense. I'd be shocked.
Yeah.
That's not something I could possibly see coming.
Wow. Okay.
Yeah, I think that's more consumer stress related.
Yes.
And inflation and the brakes that they've been trying to put on us for a number of months now, and the rates rising to slow everything down. Their intention is happening, and now I think we're going to see the next phase, which we really haven't seen, is where companies are going to start laying off. We're seeing it in the industry now,
Right.
in mortgage and
I mean,
title.
companies have got to be feeling inflation too.
Sure.
They do.
Yeah, they are.
They do. And the interesting thing is, like, if we're wanting to talk about, how that impacts mortgages, one of the things that I do is I try to look at data, because that's typically the best way to understand what's happened in the past. So you can get really good quality inflation data as well as mortgage rate data back into the early 70s. Anything before then, it starts to be a little questionable because it's measured differently sometimes. So when you look at that for a number of years, 3.8% roughly is what mortgage rates would be above the previous month's inflation rate. That's just what they've always floated around. So in recent years, that's always been about 2.7% higher than the previous, year's inflation rate. So we've crunched that number down. I would speculate that's due to technology and things of this nature to make things more profitable so they can afford to do it. Well, what's scary is that we should have been at about a 7.7% interest rate on average this year based on that trend. We're lower than that, okay? Next
Because
year,
they were keeping it down.
right. Next
right?
year, we should be a little over 11% just based on performance this year on inflation, a little over 11%. And so if those things don't happen, you'll notice back, during Carter's years, that inflation got so out of control that interest rates stayed up really high for a very long period of
In the
time.
80s, I bought a house at one of those interest
Right.
rates back then.
And even when inflation fell down to very low levels, those interest rates still stayed high because the banks had to recapitalize everything. I don't know if we're going to have that same delay, but there will be a delay. The longer we wait for them to raise rates, the longer it's going to take for them to recoup, the inflationary impact. And so that's what concerns me the most is inflation right now, by far. And I don't know that we're done.
Right. Well, and the appeal historically, too, would be when the 30-year rose, the ARMs came into play for
Right.
the spread.
Yeah.
That's still a factor, but I think the bigger question is LIBOR is no longer an index.
Right.
And so what are the new set rates going to be, and how does that going to look for the consumer? The mantra out there is buy the home and, marry the home and date the rate.
Yeah, I've heard that.
Yeah, and which I don't concur with necessarily, but it's a ploy. To
I think
try to
I
say,
just
don't-
did that.
Yeah, don't worry about
Yeah.
the rate. But
I feel like I'm
I think
cheating.
you need to be worried about potentially if you get into the ARM is what your adjustment indexes are and how frequently and what are
Yes.
what are the caps on those going to be.
Dear Lord, guys, you think it's
yeah.
going to go up to that?
Yes, it should. Now, I've mispredicted several things in the last few years because, frankly, I never expected the administration and whatnot to take a lot of the positions they have because they don't make sound fundamental sense. No matter which side of the aisle you're on, it doesn't make sense. It's almost as if they're trying to cause this to happen, and that's why it's happening. I don't know why, but it could just be bad decision making. But if the trends continue, that's what has to happen. And that's where capitalism comes in and resolves every issue over time. It will fix the problem on its own, and that would have to result in much higher rates than where we are now. So
Now you have historically also done a good job in bringing about some services in short sale that may be
Yeah.
like brain surgery as well, trying to do that.
Yeah.
But do we see that as a potential
yeah,
outcome as well?
You should see more short sales come up, and that's just especially going to be true. So if you see someone that got a partial claim, like an FHA or a VA loan, they got their partial claim, they're not going to be able to sell that home for what they have in it.
Right.
They're upside down at that point. So I would say very highly likely in those two spaces. So if you're an agent looking for an opportunity to do some short sales, FHA, VA loans, where they've gotten their partial claim, those are going to be short sales, most likely. The good part is when I did it last cycle, there was no system for short sales. So I kind of had to create one, which was not fun. Now, most of the lenders have a pretty good system for it, so it's a lot easier to navigate. still a pain. And if you don't know, I mean, a short sale just means you're paying less than you owe the lender when you
Right.
sell it.
I remember
it's
doing
not a
some
time thing. Like,
marketing
'cause
for
it takes a
short
long time.
sales. Yeah.
So you're going to see a lot of those, but the biggest opportunity right now, and this is, I'm still not seeing enough agents do it, and this is what I would be doing if I was an agent, is I would find everybody in my database that had an FHA or VA loan. I would market the fact that they have a 3% loan, because all FHA and VA loans are what's known as a qualified assumable. So if you
Right.
qualify for that loan today,
You can assume it.
from yesterday and keep that rate. So if rates are 10% and you've got a 3% FHA loan, that is a very marketable property
Yeah.
when you go to sell.
That's a sweet thing.
That's right. And agents could hit home runs right now. That is your biggest opportunity as an agent if you want to pick up, listings. That is where the money's at. Those things will sell easily. But you can't do that with conventional directly. There are some ways to do it, but they get very tricky. And you certainly don't want to just jump into that without at least investigating what could happen. So that's
So
a
going
long
back to the short sales and foreclosures, how do agents work with banks to get those listings?
Yeah, so on the foreclosure aspect, so if the bank actually forecloses and there's not a buyer at the sale, which we think this go around there will be more buyers at the auctions than takebacks, takebacks where nobody bids. We do think more people will be buying at auction. So if the bank takes it back, it becomes an REO, real estate owned. They will find someone that will manage that particular market, and that person is typically going to be the one to choose the real estate agent. So before, banks would do it directly, but now most of them are outsourcing that function to, there's several vendors out there to do it. I don't want to plug them all. They didn't pay us to do that. So, but they are
They did
out
not
there.
pay us to do that.
So that would be you would want to talk to, asset management, companies that do that for a living. The other aspect is your small credit unions and banks. They won't have as much volume, but you can develop a relationship with a key person at that bank or that credit union, and they're going to be more inclined to work with you repeatedly than to go out and try and find someone. One thing to point out, if you are an agent that does want to get into this space, typically you are putting the utilities and everything on your credit card for that property until it sells. So just be aware of that. It can get very expensive very quickly, so you want to make sure you have enough room on your cards
Yeah,
to
good
manage
point.
it.
Good point. What with that rising interest rate environment, you're also going to see bust out on deals. What give me some sense of what you're, from a practice standpoint, what you're seeing on contracts where buyers and sellers are in conflict.
Yeah, we're seeing a lot of that. So when values were just going crazy out of nowhere, just shot up crazy and rates were really low, we got influx of massive numbers of people wanting to sue their seller to force them to close. The seller's like, well, I'm going to try to get out of this deal and sell it for 50 grand more. And so we would file these specific performance lawsuits against those sellers. Towards the end of this process, we've actually had several where interest rates swung the other direction. And so then we had to modify our approach to where we're not just suing to force the sell, but we're suing for damages in addition to that for the delta in insurance. So it's pretty significant. Like, you'd be surprised at how much you get in damages there. We've had great success on it from that side. As it swings the other direction, where it's going to be buyers trying to get out, I'm going to say that the seller is probably not going to do well to sue that buyer, because it's really, really hard to sue a buyer and force them to close. And the main reason for it is, unless they have ample amounts of cash to pay cash for the property, you can't name, Bank of America and say, hey guys, y'all have to give this guy a loan. They're not going to do it.
So that's confusing to me. So why would a seller, if I'm selling my house and I am contracted with someone to buy my home, what would make me want to sue them?
if they said they don't want to close anymore, and now because the
Well, then
market's-
just, doesn't the contract end and I keep their earnest money?
well, maybe
Maybe.
that's a fight every time.
Right.
I can tell you that there's been maybe twice that I've seen where it was not clear who should get it. It's always clear, but if the parties don't agree to it, Marc's companies, they're prohibited. They cannot.
So then the closer, the buyer would
yeah.
then sue the seller to say, no, I'm not going to give you my.
That's right. And
earnest
Fights over
money.
earnest money.
yeah, and then
Yeah.
the big problem there is it's usually such a small dollar amount, it doesn't warrant go out, hire an attorney, pay them,
Right.
15, 20 grand.
Right.
Like,
Because nobody's paying 20%
right.
down anymore, hardly. But
well, and the
yeah.
earnest money is usually like 5 or 10
Yeah.
grand.
Yeah.
Like, it's small.
Yeah.
So there's just,
Interesting. So it's a
Yeah.
fight over the earnest money because
Yeah.
somebody wants to back out of the deal.
that's right. But the occasional seller will say, hey, I'm going to sue that buyer and make them close. And I'm always like, even if I get a judge to say they have to close, the mortgage company's not going to give them a loan. And that's the
Right.
big issue.
Huh,
So-
interesting. That kind of seems crazy to me when people could really work that out, but
Oh, yeah.
that's just me.
Well, that's
I
just,
guess.
but that's the point of emotion.
Yeah.
You know?
Yeah.
I thought I had my house sold.
Yeah,
just
I
got
get
notice
that.
of
That's right.
cancellation.
Yeah.
And now I'm upset, and
Yeah.
now I'm going to run down this pathway. One of the first things they're going to say, well, I'm going to sue you.
Yeah,
Yeah,
that's right.
What does that really mean?
Yeah.
Exactly.
Yeah.
And there are so many buyers out there and
Mm-hmm.
so few listings. Why not just let the next buyer come along rather than
Well,
get entailed and
But that's also
embroiled in a
shifted.
legal thing?
That's also-
shifted.
yeah.
So
It has?
the
Okay.
inventory is rising rapidly.
Jeez.
That's right.
Because
yeah.
This market's insane.
It is. I mean, we're
Yeah.
having a complete tipping point
Yeah.
to that side. So now you see we talked about it before, the price improvement from the listing
God.
side of
I
it.
lowered the price, okay,
Right,
guys?
right.
It was overpriced.
But I'm tracking, I track listings every day in our marketplace.
Yeah.
I mean, there is just a lot of inventory coming into the market. Now,
Mm-hmm.
price points to me are not conducive to where we are in the rate environment.
No.
To that side. So
Mm-hmm.
that's the challenge. You maybe,
Yeah.
if I saw 300 listings today in the market, I would say only 20% of those would be under 400,000.
Yeah.
So you've got, it's just a really interesting, so we're stagnating right now. I mean, we're.
Yeah, it's an affordability issue.
Yeah.
And that's, I don't know that that's easily fixable, not in the short term.
I agree.
Wow.
Yeah.
Wow.
So it becomes, the challenge to the overall marketplace is what does the agent do right now? Because they're going to go through whatever their activities are. They're going to get a listing. I talked to an agent yesterday who declined a listing because they felt like, and I think this was smart, they felt like the seller's expectations were unrealistic.
Yep.
And they knew that there's not going to result in a transaction, so they declined and walked away.
Yeah.
Which is smart to do.
It is.
In this environment, because having a bunch of listings, because you got marketing costs to the listings associated with as well. So,
Agents have to be savvy more than ever before.
and I
In
think
these
probably one
times.
of the preemptive strike is that they've got to get back in communication with their clientele.
Absolutely.
Irrespective, and
Yes.
just do a little, as I say, the checkup from the neck up and figure out what's going
That's
on.
right,
and
that's right.
Everything good in your family.
And being forensic and digging in to know,
Digging in, and if you've got a challenge, if you're faced with a challenge on making your payments, or you're 2 months behind or whatever, they need to be proactively thinking about strategically, how do we manage that?
Right.
And it's not shut the door and don't answer it. It's, you got to figure out what's going on and who I need to be communicating with to see what my exit strategies may
Right.
be, or my option strategies may be.
And that's a great point. I mean, I can tell you, it's always frustrating to me when I see someone that's going through a bad time and they choose to just ignore it. And that's the common approach.
Yeah.
And what I can tell you, because I've worked on the banking side of this whole foreclosure business a lot before I went out on my own, they don't want to foreclose. Like, a bank foreclosing on you is like not something they want to do, especially if they're going to have to take the property back as REO. They lose a fortune on those scenarios. They would rather work something out with you, help you sell it. They will work with you and just bend over backwards to do that.
More gentle machine gun hand.
Yeah, and they're not doing it necessarily because they're nice people. Some of them are, but they're doing it because monetarily it is the dumbest thing for them to do to take your property.
right.
They don't want it because that's not the business they're in.
Right.
to them, that's a liability.
Yeah.
Well, in light of all that then, and to close up our comments here, we've got about 5 minutes left. When an agent's client receives that notice, what should they do? And when should the borrower be communicating with their lender if they're moving into default? What's a process that you recommend for clients and realtors when they see trouble?
Yeah, like if you know you can't make your next payment or possibly the one after that, you should pick up the phone and call the lender and say, this is what I'm facing.
I'm in trouble.
And I'm going to make November, but after that, I don't think I can do December, and here's why. And they will put you with loss mitigation,
Okay.
is what they call it. And that whoever's in that department's going to work with you to help you. It may be they want to do a mortgage modification. That may or may not be in your best interest. Sometimes they are, sometimes they're not. They may want to tell you, look, we want you to market the property for a short sale. You can get a pre-approved short sale, which makes that process so much easier. From the agent side, and this happens, you have a listing and you don't know about it, and all of a sudden you find out, hey, we're going to the foreclosure sale next month. That happens, okay?
Really?
Well, in that instance, there's not a lot you can do. If that seller waits till the last minute, the only thing they can do to guarantee blocking that foreclosure sale is go file for bankruptcy. That's it. You waited too long. TROs, things of that nature work sometimes, but that's risky. Whereas if you file bankruptcy, it works 100% of the time, unless you're a serial filer. And most of them are like, well, I don't want to destroy my credit. You're facing a foreclosure. Your credit's gone.
Yeah.
Like, don't even think about that right now.
So can they just drop the price and sell the house real quick?
might be able
In
to.
the old world, yeah, probably.
I know. It's
might
like,
end up being
those
able
were
to.
old school tactics.
Right.
I don't know
Yeah.
what you do these days. It's wild.
Yeah.
That could be what happens.
Yeah,
And
yeah.
I think so. So
Yeah. Wow. Well, it's all about communication, isn't it? I mean,
100%.
communicating with your marketing, the right messages, communicating with your clients, communicating with your lenders. And, this is the thing that I have seen in my career and lifetime is that people just tend to stick their head in the sand when trouble happens. They don't want to face it, I mean, it was Scott Peck who said in his book, The Road Less Traveled, that the first thing to avoid mental unhealthiness is to just accept that life is hard and to face your problems head on.
Yeah.
And it's when we don't face our problems
Right.
that we get screwed up. So good information. Thank you so much, Matt.
Yeah, you bet.
I want to
Pleasure.
ask for your 3 takeaways to leave with the audience. 3 things that you would like to leave with them about what you do and about what you think is important about this subject. I'm going to let you think about it and let Mark go first.
I thought Matt was going. No, I'm just kidding. Well, I think the main thing, the consumer really doesn't know where to turn. So they've got to go seek guidance somewhere.
Yeah.
So I would think the first place I would want them to turn is back to the agent that sold them the home and see what they can do. And then once the agent ascertains the conditions, then they should be going forth sort of as their advocate into people like Matt who could assist in giving them really good guidance on how to communicate with the lender in that example to that side. So, and then as Matt pointed out, I mean, when you first get to that problem saying of your consumer, get in contact with your lender. I mean, you can't, if you're getting a notice and it's coming in the mail and you let it sit on the table, it's not going away.
Yeah.
You got to open it up, look at it, figure out what my situation is and that. And then for the agents right now, I would just be strongly recommending in this environment to not be thinking so much transactionally and be thinking more about consulting. Every one of them has a database. Every one of them is taught to have that database. Go back to your database, talk to them, ascertain how they're doing, see if there's any circumstances that they need to be aware of, and any advice that they could either give them or seek to get them in contact with someone that can give them advice. And perhaps bring their anxiety levels down a little bit and give them some possible solutions that they could at least begin to concentrate on. So those are my thoughts.
Good. Thank you. Matt?
yeah, I was going to copy and paste that, but
He always does that. He steals my ideas
it's
too.
fine.
fine.
lead.
It's fine. I don't want people to panic. That's the biggest thing.
point.
There's
Yeah.
going to be a lot of things that happen, especially next year, that are going to inspire panic. There's unless things change, there's no need to panic right now. We're not going to have a bank problem or anything of that nature, at least not based on any of the data that's out there. So that's number one. Number two is sellers need to understand where we are, and buyers do as well, where we are in the real estate timeline. So values were overvalued for a period of time, and we're playing catch up to that. And we were able to extend that overvaluation of values for some time because rates were so low. When I was explaining that in recent times, the difference between, inflation rates and interest and all that, if you really drive down into that, it's a big problem what has happened the last couple of years, because we've built that into the values of cars and homes and things. So instead of paying it as interest, you're paying it in the sales price. So you've got to have a certain level of affordability until the inflationary effect impacts wages, which it hasn't impacted them significantly enough to justify what things sell for. The final thing is, in addition to, staying relevant at all times, to your clients, to your friends and everything, as an agent, do mine the heck out of your database for those FHA, VA loans. I'm telling you,
Good point.
that is where the money is. You're going to have to pay some bills. Those individuals need to be selling and marketing that value that they have with that interest rate. It is a huge value, and they can make a lot more money by doing that. So.
Awesome. Thank you. My take on all of this with marketing is, first of all, if you build it, they will come. If you mine your database and you build relationships with the people you're doing business with, especially your A-listers, and they know you by name, they know that they can call you if there's a problem or something that they don't understand, that's your gold. That is your gold. So I loved what you said. Stop thinking transactionally and start thinking relationship-wise. Because when you have a relationship with your clients, when you know your database and you're marketing to them, number two, with good information, then you're building that trust level. Because like what you said, Marc, consumers don't know. We are out there trying to live our life, trying to keep our head afloat, trying to make enough money to pay this, to do that, to do the things that we need to do
Food,
to
shelter,
live. So
clothing.
we don't know all this stuff, So who should I be able to turn to? If I have a problem in my house, it should be someone that I've built a relationship with. My realtor, my lender, somebody. But, these days it's wham, bam, thank you, ma'am. You sell your house and you don't see that realtor again. They may not even be in business anymore.
Right.
So all the more reason why building your team, realtors, if you own a business and you're marketing your business, build relationships with your people. This is the most important thing, because if you build it, they will come back. And this is a crazy time. So, add Marc to your database and Matt to your database, because these are people that you can reach out to and talk to about these issues when they come up. And that's what I have to say.
Well, and then when you think about it, just as the summary to all that, is think about the number of people that have entered the real estate industry in the last 5 years.
Yeah.
Oh my God. Yeah.
a lot.
This is a whole new experience that they do not have any knowledge. Even they don't have a historical perspective to it at all, and they're probably just sitting there like deer in a headlight, going, "Oh my gosh, what just happened?"
Exactly.
To that side. So
So trusted brokers,
Yeah.
trusted title people, trusted lenders. I think to have a network, to have a team, a realtor where you can reach out when they don't know.
right,
what
and be
to
in
do.
discussion with them now.
Yeah.
Talk to them now.
Yeah.
Because you're going to get advice from that, which is going to give them more information that they can then pass on to their client that owns
Yeah.
the home. So
Totally agree.
that's it.
Good stuff. Thank you so much, Matt.
bet.
Thank
My
you,
pleasure.
Marc. Thank
Always.
you, Secured Title
Yeah.
of Texas. Thank you guys for supporting the Insiders. We'll see you next month.
Ciao.
Ciao.